The final thing to complete your audit, which is where I will spend a bit of more time now, is your audit report. And this is very, very important. In fact, this is the whole essence of audits. This is why you do an audit. So please pay attention. I'm going to summarize to you how you would determine what type of audit report that you need to give a client, because you will always find it in questions. You will see it in your exams. If there is one thing that I can tell you 100% that you see in your exams, you will see control testing. And let me use the opportunity to tell you, on my channel, there's a revision class that I did. I think I did that in July. I did a lot of work on control testing. I saw a lot of questions on control testing. So please go watch that revision class, right? Substantive testing, 100% you will see it. Then audit report, 100% you will see it in exams. And that is why I deliberately spend time on those three areas, right? So now audit report. Audit report is the outcome of any audit. And your audit report usually have at least 8 paragraphs, no more, minimum 8. That's the standard template. Yeah. So you see, let me see whether we can find anyone quickly online that you can see. This is an audit report. You can see the paragraphs: management responsibility, auditor's responsibility. They are, I mean, the date is there. They are addressing it to the members of Encore Pacific Canada. Then you see a paragraph, opinion. That's just a paragraph. So where I'm going is to let you know that opinion is just a paragraph in the entire audit report. There are other paragraphs. You can see responsibilities, then you have methodology, then inner limitations, conclusions, emphasis of matter, other matter, then PwC signs off. That is audit report. There are different paragraphs there, which is what I'm trying to explain here. Because sometimes some people think audit report is just about the audit opinion. No, your opinion is just a paragraph. Yeah. So opinion is just one paragraph out of your audit report. It's just one paragraph. And that is one thing you need to understand. Because audit report can be divided into two. The first one is whether it's unmodified, which means just the standard template from ISA, or it is modified. Talking about audit report now. If it's unmodified, that's when you say it's clean because the template was not touched. It's just a standard template that has been filled up. Yeah. The 8 paragraphs is 8 paragraphs. We've not added new paragraphs. We've not taken away any paragraphs. We've not said anything wrong about the opinion. We've said the opinion is fine. The financial statement represents true and fair view of the affairs of the company. Nothing to change, nothing to add. We're just good. And that is clean. Yeah. That is unmodified. But when the report is modified, what does it mean? It means that this audit report is not just like a standard template. It is different. And there are two ways that it can be different. Why is it different? That is why we can have two types. If what we have done affects the opinion paragraph, remember I said there's one paragraph in the audit report that is opinion. If that is the paragraph that we have touched, then we will say it is a qualified report. That is where you use the word qualified. Please pay attention because a lot of students misuse qualified and modified. See, the starting point is modification, whether the report is modified. If it is unmodified, it is the cleanest form of reports, and that is perfect report. But when it is modified, it doesn't mean that opinion is affected. But if opinion paragraph is affected, then it is qualified. But if opinion paragraph is not affected, but what we have done is to add more paragraphs, then we will say it is unqualified because we did not touch the opinion. And what did we do? There are two things we can do if we don't touch the opinion. First one is to add, there are two types of paragraph we can add. Remember, we modified it, we touch opinion here. Here we had paragraphs. That's why it's unqualified. And it can be emphasis of matter paragraph we're adding, or we can add other paragraphs. See where we're coming from. It's either it is unmodified or it is modified. When it is modified, how is it modified? Is it the opinion? Then it is qualified. However, if it is not the opinion, but we've added more paragraphs, then it is unqualified. Then what type of paragraph did we add? It can be emphasis of matter or other paragraph. And I've explained the claim one, which means everything is perfect with the audit, everything is perfect with the figures, everything is perfect with the future of the company. So everything is good. Let me explain this part, the unqualified. This is the part I'm going to explain different because this is where mostly the test. I'll come back lastly. Yeah. Also, the test this part, which you should still listen. Yeah. Unqualified means that the opinion is fine. The financial statement is fine. That's what it means. The financial statement does not have error because you only touch opinion when there's an error, when there's something that is not correct. It's about something is not correct. Say it like that. Yeah. So something is wrong here. Something is wrong. But when you want to use unqualified, it means nothing is wrong. All the figures are correct. All the disclosures are fine. However, you want to put emphasis on something. Yeah. You want to raise attention. Yeah. You want to get attention of users on issue. Yeah. It's not like there's a lie. The client has not lied about anything. Yes, everything is fine. However, you still believe that you want people that are using the financial statement to pay attention to something in the financial statement. Then you have to use emphasis of matter. So remember, everything is correct. You are the one that just think you need to still make sure that people don't forget to check something out. That is why you are putting emphasis of matter. And I think that opinion that we saw now has emphasis of matter. Look at it. He said, without qualifying our opinion. Can you see it? That is the way they always start because the financial statement is correct. There is no lie. Nothing is wrong there. Everything is correct. However, we draw your attention to Appendix B, which describes why certain items required by the assurance requirement to be included in the Appendix A have been excluded. Our opinion is not qualified in respect of this matter. And they also have other matters paragraph. Our report has been prepared solely, blah, 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 and all of that. So you can see they said without qualifying our report, which means the opinion is clean opinion. However, the report is not a clean report, it's a modified report because it has emphasis of matter. And they are telling you to pay attention to something. And sometimes they also use other paragraph when what they want to pay attention to is not in the financial statement. However, they want to tell you about it. Take, for instance, maybe the company is doing a project or is planning to do a project in the future, and auditors think maybe that project might not be successful or there might be a problem in the future. But currently, there is no problem. Going concern is fine. The figures in the financial statements all correct. Everything is fine. But auditors can still decide to put information out there that is not in financial statement. So it's not, this doesn't have anything to do with FS amount, FS figures, no. But they just want you to hear about it. So they can use other paragraph. Now, apart from emphasis of matter, which is also popular, this part called qualified is where you will be mostly tested. And now let's see. There are three types of audit reports that can be a qualified opinion. There are three types. And I will give you a summary table on how to know the type of qualified opinion or report that you should be given. And this depends on whether the situation is coming from disagreement. Disagreement means auditor believes according to standard. Inventory in line with IS2 must be measured at lower of cost, net realizable value. However, the client wants to measure at cost, or the client believes that the amount should be 45, auditor believes that it should be 33. That's a disagreement. So that's one way, one reason. Another reason is maybe auditors don't have enough information, so it can also be insufficient information. And someone asked this question in last class, that what if auditors want to do circularization to account receivable client and your client refuses to give you permission to circularize? It means you don't have sufficient information. So, which means you don't have enough information. So, like I said, it can be caused by disagreement. Remember, we said something is wrong, which means auditors don't agree with something. So, but whether it's a disagreement or insufficient information, you need to check first. Also, this figure we are talking about, is it just material? Which means it's just a significant amount, or it is pervasive. You need to check. Pervasiveness means this figure alone is going to make the whole financial statement to be wrong. But if it's just material, it means that it's only that balance that is wrong. It's only inventory that is wrong. It's only account receivable that is wrong. But when you have a situation that is addressing revenue, revenue is a major item. Mostly that will be a pervasive issue because the whole of P&L will be wrong, because your profit will be wrong if your revenue is wrong. If your revenue is wrong, your account receivable will be wrong. So it's already even touching on statement of financial position, it's touching on P&L, it's touching on so many things. Then that is pervasive. Now, in terms of the report, if you have an item that is just material and is coming from a disagreement, then you issue what you call an except for opinion. Likewise, if it is insufficient information and it's just material, it's still the same except for you issue. Except for is the most popular opinion that I always test, right? Issue except for. In fact, I always tell students that if you are confused, you don't know anything, if you don't have time to read at all, then just if you want to gamble, go for except for, because it's a popular opinion. But doesn't mean that you always be right. So it's better you understand it. Understand this table and your life is easy. It's a good summary. If the item is pervasive and is coming as a result of disagreement with the auditors, then you have to issue an adverse opinion. And if it is pervasive and is insufficient information, then you must issue a disclaimer opinion. And you know what the disclaimer is? Disclaimer is saying that I cannot issue opinion because I have not been able to do my work. An adverse opinion is saying that this financial statement does not show true and fair view. Except for is saying that this financial statement shows true and fair view except for inventory, except for account receivable. So that is the way the opinion goes. This table is going to be tested in your exams 100%, I am sure. And after your exams, you will tell me that yes, I said it. And you also know it. It's going to be tested. So please, if you have to take a picture of it, take a picture of it. If you don't understand it, let me know so I can explain again to you. This summary will save you at least 10 marks. Okay? Now that you know the type of opinion, that is the end of your audit. So let's go back to the question we are trying to solve the last time. Yes. During the audit of Canopus Co. restructuring provision, the audit team discovered that $270,000 of costs included did not meet the criteria for inclusion in IS 37. let me divide this into two because I want to ask you a question now. What if looking at, because this question is talking about reporting for sure. So is that coming from insufficient information or disagreement from what I've read so far? Who can comment on that? From the first sentence, during the audit of that provision, the auditor team discovered 270,000 costs that did not meet the criteria for inclusion as per IS 37 contingent liability and contingent asset. The finance director has suggested that no adjustment is made in 2005 financial statement as the provision is a matter of judgment and provision has been deemed reasonable by the board. The draft financial statement shows total equity and liability of 11.6 million. Okay, so tell me, this situation now, is it a disagreement or a limitation of scope or insufficient information? Is it this or this? Anyone?
I would say that is disagreement.
Fantastic. Fantastic. It's as simple as that. It is a disagreement. So, which means you are one step correct. So, it has to be either an except for or an adverse opinion that you're going to issue. Because if it's a disagreement, it can never be a disclaimer. Yeah, so you are now in between this and this. So, which means we now need to find out whether is it, in fact, is it material? We need to even check whether it's not even material at all. Because if it's not material, please remember, if anything is not material, then there is no implication. You're going to issue clean reports. It comes here straight away if it is not material at all. Then the whole financial report, audit report is unmodified. Yeah. So, but if it's material, then we need to check whether it's material or whether it's pervasive. So we don't know yet until we check our materiality level. One thing I can tell you for sure is this is just a balanced provision. So will you say that is pervasive? No. Provision cannot be pervasive. That's just a balance. It doesn't render the whole of financial statement wrong. So most times they will not give you a balance that is pervasive because it's rare. But if they give anything on revenue, it is pervasive. Yeah. So now the question is it even material or is not material? Yeah. So if you know that asset is the total of liability and equity, then they've told you that in this question, the only thing you have is equity and liability, and then that means you have an asset. And you know, for your materiality threshold, yeah, definitely, you guys did a good job. You have a rule of thumb that 0.5 to 1%, anything in that space of a revenue is material. So this is correct, right? And for total assets, likewise, anything that is more than 1% to 2% of your total assets is material. And this is profit before tax. Please take note that anything that is more than 5% to 10% of your profit before tax is material. But like someone mentioned, please always work with the lower range so that anything that is more than this lower range will be said to be material. You don't need to work with the upper range or middle or something. Just stick to this lower range. So which means anything that is more than 0.5% of revenue is material. This is what you use. Anything that is more than 1% of assets is material. And anything that is more than 5% of PBT is material. Please take note of this rule of thumb because you will always need it. And in this question that we have, they didn't give us revenue, they didn't give us profit before tax. But from what they gave us, we know what the total asset is, and that is 11.6. So we need to calculate 270K divided by 11.6. And what is that percentage? Anyone can press it for us.
2.3.
2.3%. Is this material or not?
It is.
Exactly. And why is it material? Because it is greater than 1%. This 270K is greater than 1% of the asset. So which means it is material. Right? And if it is material, then you know where that will be on your table. So which means it is material is here. If it is not material, then the report will be clean. But because it is now material, then the report cannot be clean. It is a disagreement and it is material. And in that case, you must issue except for. So for this C part of the question, you must, so you discuss it. You don't just say except for, you have to show your calculation. After showing your calculation, you let them know there is a disagreement. Then based on that, an except for audit report, except for qualified opinion in a modified audit report. So the report is modified and except for. And please always put it there that with basis of qualification, because anytime you qualify opinion, you must always add the basis of qualification, which is what you have discussed, disagreement. I hope that is clear.